Welcome to this edition of How to Retire with Ben Fuchs. I am Rachel Lutzker. I've got some big shoes to fill here, stepping in and joined by Ben Fuchs, the founder of Fuchs Financial. Thanks for having me here. This is great.
Oh, I'm honored that you decided to join us. I think we're all graced by your presence.
Thank you. You're very kind. But we've got a lot to talk about today. Yes. This is one of those challenging times. You know, we're going into an election year. Right. Everything is calm, everything is cool, everything is collected. But let's face it, there is really a lot of concern over potential tax changes going into this season. So can you speak a little bit on that?
Yeah, I think one of the things that I hear a lot about are what are the potential tax challenges if Kamala becomes president. And so, I mean, I think that there's a lot of, I would say, scare tactics, a lot of concern, a lot of uncertainty. So I'm going to go through just some of the proposals, and then maybe we can talk through some of the impacts. So one of the things she's proposed is that individuals earning over $400,000 would now be taxed at 39.6%. Now, because I am presently not making over $400,000 a year, I have no problem with that. Go for it. Next, there will be a surtax. So capital gains taxes will go up. This is one of the bigger concerns for a lot of people. So potentially raising capital gains taxes from 15 or 20% to 28 or even 33% for top earners. Now, to put it in perspective, if you have a $100,000 sale now, and you don't have a lot of other income, you would be paying 15% in taxes, so like $15,000 on that. If you make a lot of money, $20,000.
Right.
But if all of a sudden that goes from $20,000 to $33,000, that's going to change a lot of different holding patterns for people. I think that you're going to see less buying and selling, which might not be good for the overall stock market. The stock market survives on buying and selling. And so if you have people that have portfolios that are constantly being traded, and now they have to pay all these taxes every time they buy and sell, that could be somewhat of an issue.
It does look like it is a pretty significant change for some, and that, of course, does start to instill a little bit of panic in people. So what do you do, or what should people do in that situation?
So not panic.
Not panic. Easier said than done.
Well, let's talk about it for a minute, okay? First of all, I like to gauge what will happen based on who's voting for it.
Okay.
So, I don't have a crystal ball. I can't tell you what's going to happen tomorrow. I have no idea what the, senators and houses are going to do. But I can tell you that a lot of these people have a fair amount of money in stocks. And if it would affect them and take more money out of their pocket, I don't see them voting for it, respectfully. Now, that's cynical. I'm not trying to be political one step or the other. That is for both parties across the board. If it's going to cost me an extra 10% to sell my stuff, I don't want that to be the case. So it doesn't bother me. It doesn't scare me. I see it as unlikely. It's a concept. It's an idea. Great. Does it make sense? I'm staying out of that part because this is not a political show and will never be.
Right.
But that's how I look at it. Now, yeah.
But you look at these changes and people do panic in situations like that. It's the giant what if. What if this happens? What if that happens? And how do you get people to kind of reel it in and say, again, I don't have the crystal ball. I don't know where this is going to go, but this is how we can protect you, protect what you have, protect where you are so that we don't fall into a tough spot.
So if we look like we're going down that path, we do have to change the way that we're managing money. We have to change the way that your portfolio is being managed. One of the frustrations for me is that, and this is totally off topic, you're welcome, but one of the frustrations for me is that as times change, as things change, a lot of the tried and true methods of financial planning don't necessarily change with the advisors. For example, I've complained in the past, and Paul has heard me multiple times complain about the 60-40 rule and how, when stocks were at when bonds were producing 15% returns in the 80s, 40% of your portfolio in there, it makes a ton of sense. But when it dropped down to 2.5%, people were still putting 40% of the money there. It didn't make as much sense. And people were very surprised when all of a sudden interest rates went up and they lost a lot of money in their bond funds. That's a time when people need to adjust and change. If these things do come into play, and they look like they're going to, again, we're going to have to readjust the way that we manage money to protect our clients.
Mm-hmm. So do you find people, though, that come in, they're like, okay, well, I'm too nervous to do anything. I'm too nervous of what the impact could be.
The reality is that we have to change. If we don't make changes, if we're not open to those, then we're going to find ourselves in trouble. I think it's important to understand that as situations change, as economic conditions change, other things make sense. Look, it didn't make sense to have as much money in bonds when they were at 2%, but it did when they were at 10. You change over time based on conditions. I have a lot of people in their 70s that still want to put all their money into CDs. And don't get me wrong, I like banks, but banks really don't pay all that much. That's not where you can get the most amount of money for your return. So we have to keep that in mind. I think the other one that I see, the other tax change that I see talked about a lot, is the 25% minimum income tax. I'm going to read off and I quote here, ultra rich. That's defined on Kiplinger as people with at least $100 million in wealth, according to a September article from Kiplinger.com. This is one that I see debated a lot. And again, sorry people, I don't have over $100 million. Doesn't bother me at all. If that means that a billionaire cannot build another rocket ship, I am not going to spill a tear for anybody. Now, where does it stop? Okay, it was $100 million when we start. Does that mean that they're going to lower it to 50, to 30, to 10, to 2? Like, that's a concern. So I see that side of it. But for me, if you were talking about a tax on people having $100 million, no, that doesn't bother me so much. Because look, I'm taxed on my house every year. I haven't sold it.
Right.
Hopefully it maintains its value, but it's the same concept. If I have to be taxed on my house, I don't mind you being taxed on your stocks when you have over $100 million. Fair?
Fair.
Okay.
Be taxed on your rocket ship.
Right.
Exactly.
Right. Well, again, if it's worth over $100 million, but they could depreciate it, maybe it's not worth it. Or some of these billionaires can be like, all right, I'm not a citizen of the US anymore, I'm moving out. Like, that's a possibility. If they're going to be taxed 25% of their wealth every year, that's a big deal. Thank you for watching. If you'd like to schedule a 15-minute phone call, go ahead and click the link in the description below, and we look forward to talking to you soon.